Welcome back to Synaptic Dividends. We break down a new dividend stock often to help you build your passive income portfolio. If that's your goal, make sure you're subscribed so you don't miss out. Now today, we are talking about a real heavyweight, Cintas. You've probably heard it called a dividend aristocrat, and for good reason. It's been raising its dividend for over 40 years straight. That's an incredible streak. But is the reputation still deserved today?
So that's the big question, right? Is this legendary dividend streak built on a rock-solid foundation, or is it just kind of running on fumes from the past? To figure that out, we have to do what we always do. We gotta follow the money. And that journey starts with understanding where all that cash even comes from in the first place. So first things first, the cash-generating engine. A dividend is only as strong as the cash flow that fuels it. So let's pop the hood and see what kind of horsepower Cintas is really working with. And when we talk about fuel, the single most important number is free cash flow, or FCF. Just think of it like this. It's the company's actual take-home pay. It's the real, cold, hard cash left sitting in the bank after all the bills are paid and after they've reinvested enough to keep the business running smoothly. This cash is the lifeblood for everything, especially for paying us, the shareholders. And wow, just look at this trend. Cintas isn't just making cash, it's getting better and better at it every single year. You can see it right here, jumping from $1.2 billion in 2023 to nearly $1.7 billion in 2024, and it's expected to climb even higher. This cash engine isn't just running, it's revving up.
Let's just pause on that for a second. Over $1.76 billion in pure cash profit in a single year. You can't fake a number like that. This is the bedrock, the foundation. It's a massive growing pile of cash that makes a healthy, sustainable dividend possible.
Okay, so we've established Cintas has a powerhouse cash engine. That's great. But here's the real question for us as dividend investors. Is the company actually sharing that wealth with us? To answer that, we've got to look at the dividend's track record. And the answer is a big, flashing, neon yes. I mean, just look at these growth rates. We're not talking about tiny little increases just to keep a streak alive. No way. We're seeing massive double-digit raises, over 26%, 21%, 17%. These are the kinds of powerful increases that really compound your wealth over time. This right here, this consistency, this is what separates a pretty good dividend stock from a truly great one. It shows a real, deep commitment from the company to not just pay us, but to meaningfully grow our return year after year. This is how a small investment can turn into something really significant down the road. Now for what might be the most critical question of all, the dividend safety net. The growth is awesome, we love to see it, but is it safe? Can the company actually afford to keep making these huge raises, especially if the economy hits a rough patch? This chart tells us everything we need to know. It shows us exactly where all that free cash flow we talked about is going. And look, only about 35% of the company's cash profit is actually being used to pay the dividend. That means almost 2/3 of all that cash is being kept right inside the business to fuel even more growth. So why is that such a big deal? Well, think about it. Compare Cintas to a company with a really high payout ratio, say 80 or 90%. For that company, any little hiccup in the business, a bad quarter, a recession, and that dividend is suddenly at risk of being cut. But Cintas, with its low 35% payout, it has a massive safety net. It's got this huge cushion to protect the dividend, and it leaves tons of room to keep giving us those big raises in the future. All right, we've looked at the cash engine, the growth history, and the safety net. Let's put all the pieces together and come to a final verdict. So when you step back, the story here is just incredibly clear and consistent. You have a powerful, accelerating, cash-generating machine. The company uses that cash to reward us shareholders with a proven history of strong double-digit growth. And it does all of this while keeping a huge dividend safety net, which makes the payout both super safe and gives it plenty of room to keep growing. So back to our original question. Is Cintas's 40-year dividend streak built to last? Based on these numbers, the answer is a resounding yes. This isn't a dividend that's just coasting on its old reputation. It's backed by the incredible financial strength of a superior business. The numbers really do tell a story of growth, consistency, and safety. If you want to go deeper and understand the full business model behind these numbers, check out our long-form podcast analyses on our main channel, Synaptic Investing. And of course, if you found this breakdown helpful, a like is always appreciated, and subscribe for more dividend analyses.
Thanks for watching.